Hello, this is Nana Ama Okua. This is the next in my series of videos on why investing matters. In my previous sessions, I've talked about why the need to set financial goals, why we need to grow our money, or why the need to invest to grow our money, to put some money aside for our children's education, to put some money aside for some important things later in life, and also why the need to some of the considerations you need to have when you're investing. So you need to think about your attitude to risk, your risk profile, diversification, some of the efficient investing opportunities that are available. The other considerations I think we talked about in our last session was on where to look for information. So typically you find these on companies' websites, investor relations, in their financial statements, in their certain disclosures that they need to make to the stock exchange or to the public in general, as part of their responsibility of being a public company. Today, I want to talk about, so if you take out a financial statement, what are some of the metrics to look out for? So for one of the metrics, or the key metrics typically that most companies will report are their revenue, revenue growth, margin trends, their return on invested capital, their assets turnovers. They also look at certain valuation multiples like their PE ratio, their earnings per share, their what are their enterprise values, what's their debt levels. These are all things that can help you form an opinion on where the company is at and where it's likely to be in the future, and whether it's a good opportunity to look after. These are purely financial. The other things you could also look at are on non-financial aspects, like things like soft aspects, like things like environmental issues, ethical issues, governance. How are they run? What's the management style like? What's the management? Again, it's all about whether you want to invest in them, and whether your own, should I say, risk appetite is in line with where the company are. So in terms of your revenue growth year on year, what's it looking like? Is it growing ahead of the previous year, or has it fallen? If it's fallen, do you know reason why? Is it a particular issue that's affecting the whole market, or just that sector, or just that company? Or has it made an acquisition, or has it made certain disposals that has meant comparing year on year, it's not possible? Or other things like things like currency movements that has caused these effects. The other thing also to look out for within revenue is, what are the different types of revenue or segments that or businesses or brands that they work with. And it might be difficult to find this information in certain reports and accounts, but if you can find out, how are those within the revenue, how are the brands or the segments comparable year on year? Again, that can also give you an indication of where the businesses are at, what are the key products that are selling, and are they likely to sell in the future, or are performing well, and are they likely to perform in the future? The other key metrics to look out for is the margin, or should I say the operating profit. Some people would also look at EBITDA, which is earnings before interest, tax, depreciation, and amortization. This is typically what most measures are done against. And again, looking at what the what the margin percentage is. Is it typical in that market? Is it typical for its to compare to the previous year or compared to the previous 2 years or 3 years? Is that typical? If it's different, for example, in a retail business, you might have very low margins, or okay, so a spike in a particular year is cause for concern, not concern, but something to question and find out and understand why. It might be an acquisition, it might be something extraordinary, but then it's good to understand that. And also, what are the growths compared to previous year-on-year growth? Again, how does that compare to the previous year? How does that compare to other companies or competitors or other companies in the same industry? The other measure to also look out for is what they call ROIC, return on invested capital. So this is EBITDA after tax over the invested capital. And again, there's some rubrics to the calculation on that, but basically it's probably what industry talk about. It's probably a better measure than the margin, just looking at the margin. So ROIC is a better measure than the margin. And again, the key thing with ROIC is it needs to be, you need to have your own work, so your own cost of capital. So as an investor, what's your cost of capital? You're taking some money from somewhere to invest, but what's your cost of capital? That's quite a detailed calculation, but just to give you something to go by, maybe you borrowed some loan, and what's your loan rate? That's a very simple way of it. If your loan rate is 10%, then obviously you want to beat, and you're going to put that money into a share. You want to make sure that you earn something more than that 10%. So what you're looking for from ROIC is the ROIC ahead of my cost of capital for a start, and then understand what's happening in the ROIC, if it's high, if it's low, how does other industries compare on that measure. Again, if it's quite different, you need to understand. If it's the same, then it's probably okay. The thing too with ROIC is also, you can also break that down further, because you can find your revenue measures from there, you can find your margin measures from there, and you can also get your assets turnover, which are, these are efficiency metrics. So this tells you how much your assets are, how efficiently is the company utilizing its assets. So you might have very good margins, but if the assets are not being used efficiently, then the ROIC might not be as good as you expect it to be, or as good as your margin is. Or you might have very low margins, but you might be using your assets quite efficiently, turning them compared to your sales, and it might give you a relatively good ROIC. The other thing to look out for again is asset turnover, and you can deduce this from your ROIC. And this is basically your asset level compared to your level of sales. So given the level of sales and the level of assets, how much are you utilizing it, or how much sales are you churning out of your assets in a nutshell. Anything greater than 1 is great, but then if the industry is 5, then you're not necessarily great. But if it's in the 1, then you're probably not utilizing your assets as much as you should be. Or if it's not as good as competitors, then you're probably not doing as well as they are doing, and you probably can understand why. What's the time? How much have we gone? So the other metrics are valuation. So these are, what's the company worth? Yes, you can look at the assets and think, okay, oh, it's worth 10 billion. It's quite a high number, but it might not necessarily be, it might have a lot of debt, or it might have certain assets that are not so valuable. So it's good to understand, okay, what's the company worth, and what are these assets within. So you could also look at certain valuation multiples. So certain multiples that will help you understand, okay, this company, you can make comparisons with other companies. So if it's enterprise value, it's it's about maybe twice sales, or it's about half of sales, or it's about a fifth of sales, then how does that compare to other companies in the industry? And is this a benchmark that you can use? Is there a benchmark that you can use and measure it against? The other ones is PE ratio. These are price to earnings. So this is the market price, so the share price times the number of shares over the earnings. So again, if you're basically if it's more than one, it's trying to tell you it's priced. The market sees the company as more, maybe should I say, probably it's priced more or less priced ahead of its earnings, or the number of times it will take you to earn. If you buy the share, the number, and compared to the earnings, the number of times it will take you to make for the company to earn that earnings. Again, typically, this is something you need to compare to other companies as well, the industry metrics on that level. The other metrics is earnings per share. So this your earnings divided by your number of shares. Again, this helps you understand, based on your number of shares, is the company doing enough? Yeah. Another valuation multiple is enterprise value over the EBITDA. Again, this tells you, based on the valuation, how many number of times on looking at the profits, or the quasi profits is the EBITDA, how many times is the company valued compared to its profits, quasi profit or EBITDA. Then this is a key metrics that is used in many valuation. Okay, I think we're going to stop here for today. Just to recap, we've looked at certain measures that certain key measures that you can look at when you're looking at the financials of a company. So your revenue growth, the margin growth, what are the trends compared to years, compared to other companies in the industry, your return on invested capital. This is basically looking at your margins. This includes your margin makeup, your assets versus your efficiency. So you could be doing quite well margin wise, but if you're not efficiently using your resources, then it might not reflect so much in your work. The reverse is true. You might be efficiently using your assets, but then your margins might be quite low. So it sort of helps you break things down to the basic level and understand how the company is performing. And things like asset turnover, again, this is your efficiency metrics that you can delve into. Then you've got your valuation metrics, your PE ratios, your EPS, your enterprise value versus your EBITDA. As always, any questions, do let me know. Do email me, amapoks1982@gmail.com. Thank you very much, and hopefully see you soon. Thank you.